Did you know that starting in 2026, spending just 45 days in Australia could make you a full tax resident again, even if you live overseas? That's right. You could be working in Dubai, living in Bali, or enjoying retirement in Spain, and still owe taxes to the Australian government. Sounds crazy? It's real, and it's coming fast. The Australian Tax Office is completely redefining what residency means, and if you're not paying attention, you could get caught in a trap that drains your income, taxes your offshore earnings, and ties you back to Australia without even living there. These new rules could turn short visits into financial nightmares, cost you tens of thousands in taxes, and destroy your global freedom. In this video, we'll break down the 10 biggest reasons why you might need to leave Australia for good before 2026. And trust me, reason number 7 will shock you. Let's dive in. Number 1. The 45-day rule will trigger residency. Let's start with the most shocking change, the new 45-day rule. Under the upcoming legislation, if you spend just 45 days in Australia within a single year, you could automatically be deemed a tax resident again. That's less than a week and a half of vacation time. In the past, tax residency was judged by several factors, like where you lived most of the time, where your permanent home was, and where your economic ties existed. But this new rule is brutally simple. Step foot in the country for 45 days, and you might trigger a full tax obligation, whether you're living abroad or not. Now, think about the ripple effect this could have. You fly back for a family wedding, visit your parents, or attend a work conference in Sydney. Innocent trips that could now reset your tax status. Once you're considered a resident, you'll be taxed on your global income, not just the money you earn in Australia. That includes any offshore business profits, overseas salary, rental income, or even capital gains made abroad. What used to be a simple visit could suddenly tie you to massive tax bills, audits, and stress you never saw coming. This change doesn't just affect retirees or digital nomads. It affects any Australian who lives or works overseas but wants to stay connected to home. If you're not carefully tracking your time, your freedom to come and go could cost you everything. And once you trigger the residency, getting out of it isn't easy. This is why planning ahead before 2026 isn't just smart, it's absolutely essential. Number 2, global income could be taxed. Imagine this, you're living your dream life abroad. Maybe you're working remotely from Portugal, running a business in Thailand, or freelancing in the UK. You've paid taxes locally, followed the rules, and assumed that since you don't live in Australia anymore, you're in the clear. But under the new residency rules, if you're classified as an Australian tax resident, even accidentally, your entire global income becomes taxable by the ATO. That's not just your Australian earnings. We're talking every dollar you make anywhere in the world. This means your salary from a UK employer, profits from your Dubai-based business, rental income from an apartment in Berlin, even gains from cryptocurrency or international stocks could all be subject to Australian tax. The ATO doesn't care where it's earned if they think you're a resident. And here's the kicker. If your new country of residence doesn't have a favourable tax treaty with Australia, you could end up paying tax twice on the same income. Yes, double taxation is a real risk under these rules, and it's one of the most financially devastating outcomes. For many, this could completely destroy the benefits of living abroad. The whole point of becoming a global citizen is often tied to financial freedom and lower tax burdens. But if Australia is quietly keeping its hand in your wallet, that freedom disappears. And once you're flagged as a resident, you'll be stuck filing complex tax returns, facing international reporting requirements, and dealing with a growing web of compliance headaches. It's no longer enough to simply live overseas. You have to legally, clearly, and provably separate yourself from the Australian tax system or risk everything. Number 3, lack of clarity creates risk. One of the most dangerous parts of the new tax residency rules isn't just the strict timelines or expanded income scope. It's the vague language used to define them. The new framework introduces terms like objective testing, sufficient ties, and connection indicators, but it doesn't clearly explain how these will be measured in real-life situations. That means two people in almost identical circumstances could be judged differently, depending on how the ATO interprets their specific case. And when millions of dollars in taxable income are on the line, guesswork becomes a serious liability. For example, what does it actually mean to have a sufficient connection to Australia? Is it just owning property? Visiting family? Keeping a Medicare card? The guidelines are loose, and that's intentional. It gives the ATO the power to decide subjectively who counts as a tax resident. This creates a legal grey area that leaves many Australians overseas feeling anxious and vulnerable. Even if you think you've done everything right, you might still get a letter from the ATO saying otherwise. This kind of uncertainty isn't just frustrating, it can be financially crippling. You could spend thousands on legal advice, restructuring your life, only to find out it wasn't enough. Or worse, get caught in an audit years later for something you didn't even know violated the rules. If you're living abroad, you need absolute clarity and a rock-solid residency plan, not hopes and assumptions. Without it, you're gambling with your financial future in one of the most unpredictable tax landscapes Australia has ever introduced. Number 4. Limited use of tax treaties. Many Australians living overseas take comfort in the belief that double tax agreements, DTAs, will protect them. After all, Australia has treaties with dozens of countries meant to prevent you from being taxed twice on the same income. But here's the problem. Those treaties only apply if both countries agree on your tax status. And under the new rules, Australia is giving itself far more power to override those treaties by unilaterally deciding you're a resident. That means even if your host country sees you as a resident, Australia might disagree and demand their slice anyway. The core issue lies in the sequence. Australia will use its own new rules to determine if you're a resident, often without considering how your current country classifies you. If both countries decide you're a resident, you might be protected by the treaty. But if there's a mismatch, or if your new country doesn't have a treaty with Australia, you could be taxed by both. That includes not just income tax, but also capital gains, dividends, and even business revenue. This is especially risky for Australians in popular expat destinations like Thailand, UAE, or even the US, where the treaties are either weak or subject to exceptions. Relying on a tax treaty for protection in this new environment is like hoping a fire escape works during a flood. The tools don't match the threat. You need a proactive plan that doesn't just assume a treaty will save you. It needs to legally separate you from Australian residency status before the rules tighten in 2026, because after that, even international protection might not be enough. Number 5. Exit planning will be tougher. Leaving Australia used to be relatively simple. You moved abroad, updated your address, cut a few ties, and that was often enough to establish non-residency for tax purposes. But under the new rules coming in 2026, it won't be so easy. The ATO is shifting toward a much stricter definition of cutting ties, requiring clear evidence that you've genuinely separated yourself, financially, socially, and personally. That means every little connection you still have to Australia could be used to pull you back into the tax net. We're talking about things like keeping an Australian bank account, maintaining private health insurance, owning property, having your kids enrolled in school, or even just visiting friends regularly. All of these factors can be interpreted as signs you haven't truly left, and the more of them you hold on to, the harder it will be to convince the ATO that you've exited Australia in a meaningful way. This means that proper exit planning is no longer just a formality, it's a legal strategy that could determine your financial future. If you're thinking about relocating, the time to act is now, not after the rules kick in. You'll need to map out every part of your life and decide what stays, what goes, and what needs restructuring. The longer you wait, the more complicated it becomes, and the fewer options you'll have. This isn't just a paperwork issue, it's about protecting your global lifestyle and keeping control of your income. Don't let poor planning force you back into the system you were trying to escape. We poured hours into researching and crafting this for you. So if it helped even a little, drop us a comment with your thoughts. It's one click to subscribe, but it means the world to us and helps keep this content coming. Number 6. Property ownership could tie you to Australia. Many Aussies living overseas still own a home or investment property in Australia. It feels like a smart move. Real estate is stable, it's home, and maybe one day you'll come back. But under the 2026 tax residency changes, holding on to Australian property could be a massive liability. Why? Because owning a residence, especially one that's available for your use, can be seen as maintaining a continuing connection to Australia. And that could be enough to trigger residency, even if you live 10,000 kilometers away. The ATO will consider whether your property is rented out or available for personal use. If you keep a home that you occasionally stay in during visits, or if it sits vacant while you're abroad, that could be interpreted as intent to return, which raises red flags. Worse still, the moment you're considered a resident again, you could become liable for capital gains tax on any increase in property value, even if the property is located overseas. In other words, your local real estate abroad might get taxed back home. For Australians holding property both at home and overseas, this adds a new layer of risk and complexity. It's not just about property taxes anymore. It's about how those assets define your identity in the eyes of the tax office. If you plan to live overseas long term, you may need to rethink how your property holdings are structured, or even consider selling. The dream of keeping a home in Australia for one day could end up costing you a fortune if it quietly makes you a tax resident without your knowledge. Number 7. You might owe superannuation contributions. Here's something most people never see coming. Superannuation obligations don't always disappear when you move overseas. Under the current system, non-residents typically aren't required to keep making super contributions. But with the new 2026 tax residency rules, if you're reclassified as a tax resident, even by accident, you could find yourself legally obligated to resume payments into your Australian super fund, even if your income is earned abroad. This becomes even more problematic if you're self-employed, running your own business overseas, or working for a foreign employer. The ATO may still expect 9.5% or more of your gross income to be contributed to an Australian super fund, money that may not benefit you in the short term and could be heavily restricted in access until retirement age. For many, that's a forced financial burden that makes budgeting more difficult and reduces the advantages of working or investing abroad. And don't assume this will go unnoticed. With global financial data sharing agreements in full swing, the ATO has increasing visibility into foreign income streams, business ownership, and employment contracts. If they determine you're a resident, they can enforce these contributions, demand back payments, and even penalize non-compliance. What was once an optional part of your financial strategy could quickly turn into a compulsory expense. This is why planning for non-residency status isn't just about tax savings. It's about avoiding a complex web of legal obligations that can follow you anywhere in the world, including right into your retirement. Number 8. Business income may be targeted. If you run a business overseas, this one could hit especially hard. Under the new residency rules, being classified as a tax resident of Australia means the ATO can claim taxing rights over your entire business income, even if your business is based abroad. That's right. Even if you're operating a tech startup in Singapore, a consulting firm in Dubai, or a hospitality business in Bali, your earnings might still be seen as Australian taxable income if the government believes you're maintaining significant ties to Australia. This doesn't just mean income you personally draw from the business. It could extend to profits retained in the company, dividends paid out, or even capital gains if you sell your business or shares. The risk becomes even higher if you're still using an Australian bank account for transactions, maintaining a local accountant, or if your business's intellectual property was created while you lived in Australia. Each of these factors could be used to argue that your business has an ongoing Australian connection, making it taxable under the new rules. For entrepreneurs, this is more than just a tax inconvenience. It could be financially devastating. You might face double taxation, increased compliance costs, and penalties for failing to declare offshore income that you didn't realize was considered taxable. Suddenly, the freedom of building a business abroad turns into a compliance nightmare. If you're running or planning to launch a business outside Australia, now is the time to restructure and separate your professional life from your Australian identity. Otherwise, your overseas success might come with an unexpected Australian price tag. Number 9. Travel freedom becomes a liability. In the past, returning to Australia for holidays, family visits, or work events was no big deal, even if you lived abroad. But under the new rules, these simple trips could become high-risk moves. Spending just 45 days in Australia within a financial year may be enough to trigger tax residency, even if your life is fully set up overseas. That means your freedom to come and go, to stay connected with your roots, suddenly turns into a liability that can cost you thousands in taxes. Even more concerning is how the ATO might interpret your reasons for travel. Visiting elderly parents, attending a cousin's wedding. These emotional, deeply personal trips could now be seen as maintaining significant ties to Australia. Combine that with other factors like keeping a driver's license, Medicare, or even just having an Australian mailing address, and your temporary visit starts to look more like permanent attachment. It doesn't take much for the ATO to argue you've re-established residency. For global nomads, digital workers, and long-term expats, this rule fundamentally changes how you interact with your home country. What used to be an open-door policy is fast becoming a trapdoor. If you don't plan your travel carefully, 1 or 2 spontaneous visits could undo years of residency planning, forcing you into tax filings, declarations, and audits. This is why having a clear and legally supported residency status is no longer optional. It's the only way to protect your lifestyle and income while still staying connected to Australia, safely and legally. Number 10. Losing flexibility for future tax planning. One of the biggest long-term consequences of the 2026 tax residency changes is something few people talk about: the loss of flexibility. Once you're classified as a tax resident again under these new rules, reversing that status becomes significantly more difficult. The criteria are rigid, the monitoring is tighter, and the definitions are broader than ever before. What this means is simple. If you get pulled back in, it may take years to get out again, no matter where you actually live or work. Tax planning used to involve strategy and timing. You could structure your move abroad, choose the right financial vehicles, and gradually sever ties with Australia while building a life overseas. But under these new laws, one wrong move, like a short visit or a bank account left open, can reset your status, locking you back into the Australian tax system. Once you're in, every income stream, investment, and business asset becomes subject to reporting and taxation. That level of inflexibility kills global tax planning opportunities and restricts your options for optimizing your financial life. This is especially alarming for entrepreneurs, remote workers, and early retirees who rely on agility and low-tax environments to grow wealth. You may have big plans for the next 5, 10, or 20 years, but if Australia claims you as a tax resident under these new rules, those plans could get derailed fast. The ability to pivot, relocate, or restructure your finances in response to global changes could vanish overnight. And once that door closes, getting it open again will be a costly, uphill battle. By now, it's clear. The 2026 Australian tax residency rules aren't just a tweak in policy. They represent a complete shift in how the government views your connection to the country. Whether you live overseas full-time or just split your year between countries, these rules can silently pull you back into the tax system, even if you think you've done everything right. From spending just 45 days in Australia, to owning property, to running a business offshore, every small tie could trigger full tax residency. And once that happens, your global income, your super obligations, your business revenue, and even your freedom to travel become tangled in a complicated, costly system that's tough to escape. That's why planning ahead is critical. Don't wait until these laws are active, because by then, it may be too late to make the changes that protect your future. Now's the time to evaluate your ties, clean up your residency status, and prepare for what's coming. If you're serious about your global lifestyle, your finances, and your freedom, 2026 is the deadline, and the clock is ticking.